Right, let's kick off. Hello, everybody. My name is Olaf. I'm one of the three managing partners from Capnamic Ventures. We are a Berlin and Cologne-based early-stage tech venture capital investor. And my past, before I switched sides of the table, I used to be an entrepreneur. I've founded, grown, and exited 3 startups in the tech area. And since 2007, I'm investing in early-stage tech companies.
Is this on? Can you hear me? Great. Okay. Hey, everybody. Thanks to Marco and the NOAH team for having us here. So my name is Koplin. I lead Cisco Investments in EMEA. Cisco Investments is the venture arm of Cisco. We invest about $250 million a year in enterprise software. In Europe, we invest about $30 million a year to give you an idea of the size of the fund. We have 6 people in EMEA, 4 in London, 2 in Tel Aviv. And we tend to invest mostly at the Series A and B stage. One thing that may sort of come up here that's kind of important is what type of corporate investor we are. So we do still do some what I would call strategic investments from time to time, but the majority of what we do as investors is thematically based. So very similar to a typical venture capital firm. We look to both make money and have some kind of learning and potential opportunity with the portfolio companies that we invest into. So companies, the spaces we look at, cloud, big data, data center and storage, IoT, security, autonomous, silicon and optics, and what I'll call the future of work. So things like CRM, AR, VR, and other apps.
Perfect. Yeah, I'm Josef. I'm the CEO of Relayr. I know Olaf now for too long.
About 15 years. Yeah.
15 years. Relayr is an IoT platform company where Cisco is an investor, and Kleiner Perkins and a few others. And the previous company that I did, Olaf was my first investor, and we had Intel as another investor in there. And then we got acquired by Cisco, and then Cisco, after we left Cisco, also invested in a new company. And I wanted to share some of the experiences, what to expect, what not to expect, what kind of expectations to have when you raise money from a corporate venture capital fund. And just share a little bit of the learning so that you know what you get yourself into when you raise money from the corporate venture guys.
And I'm here to tell you that it's all good.
And my perspective is the perspective of a former entrepreneur, which have worked with corporate investors as well, and now as a, let's say, normal venture capitalist, working in syndicates with corporate venture capitalists. We have prepared a slide deck of about, I think, 47 slides, which we would like to show you. This is the first slide, and the last as well. So, no, we would keep it interactive. And if you have questions, just raise your arm, and we will answer, and maybe we can start a discussion. Otherwise, we have some questions prepared, and we'll tell you something. But Josef, you are sitting in the middle, and that's why the spotlight is mainly on you. Maybe you can put some color on your experiences with corporate ventures and venture capitalists and normal venture capitalists.
Yeah, I think that the general thesis when you raise money, and this really is now the 4th company, so I've done this a few times now. I think what most entrepreneurs typically miss is doing due diligence on the investors. And I totally understand the challenges that some of you might currently experience when you constantly run out of money and you're constantly broke. It's hard to do due diligence when you just desperately need money. I get that part. But the problem is you're engaging with someone who's going to be with you for quite a bit. And I think it's incredibly important to understand that the real asset a venture capitalist brings is not necessarily the money, it's the network and it's the experience that a VC brings onto the table. And that being said, there's a difference between venture capitalists, traditional venture capitalists, and also strategic investors. And a lot of people think that it's sometimes difficult, sometimes challenging, or even dangerous to raise money from corporate investors early, and I would greatly disagree because there comes a lot of value. So I'll give you a few examples of the value that we're seeing, and then maybe talk a little bit about the expectation setting. When we did Chulex, we did energy management for data centers, and tried to help companies reduce OPEX costs by saving energy. And a big topic for us was around servers. And for us, changing settings in a data center and moving load from here to there, we had big brand recognition problem in the early days. So by having Intel as an investor, independent to the value that they're really bringing, a lot of people associate parts of the shininess of the Intel brand with you as a company and just assume there's a lot of thought process behind the investment, and that in itself has a lot of value. And secondly, you're getting really, really close to the engineering, to the roadmap, where you see where markets are developing, which helps you to stay ahead of the curve. But independent to these values, I think it's very, very important to understand that you have to put the right regulations in place. So as an example, when you raise money from, let's say, Cisco, and a Google or a Dell might be interested in acquiring you have to make sure that you're able to remove your corporate investor from the board, or stop documentation distribution to avoid a potential competitive situation, right? Because you want to provide as little insights as possible for specific situations. So those kind of things are very, very important when you set up the foundation and when you raise money from corporate venture capitalists. And then the other really important topic is around expectations. Cisco is, I've been with Cisco after the acquisition of Chulex, and Cisco is, for me, a really great company because it's all about customer centricity, so it's all about sales. So you would assume that when they invest in you, that you could be part of that, or you could leverage the sales machines. But you gotta always understand how a salesperson is being incentivized. And if you are incentivized to sell servers or security or software, you couldn't care less about the investments that Cisco is making, because your job is selling what's on the truck and selling what Cisco produces. And I think there's some misalignment sometimes that founders think just because somebody invests, they would actually be part of their ecosystem or would resell this. So I think having a clear expectation setting exercise prior to the investments is really important to avoid confusion or disappointment along the way. And then the last thought is that statistics show that it's highly unlikely that somebody invests in you as a first step to actually acquire you. One of the main reasons, and John needs to keep me honest here, is they use the ecosystems of the investment as a sensing tool. Right? They want to understand where our market's going to, and what are customers thinking. You're really close to essentially prototyping to some extent of ideas and see what's really resonating, and then they take these learnings and become a better, smarter, and more dangerous, in the most positive way, more dangerous company. So I think the statistics say that 7 to 10% of the corporate venture investments actually lead to an acquisition, right? And that just is important to understand. And then lastly, when you think that there might be a competitiveness being perceived in the market if you announce an investment, most of the strategic investors are happy to not make an announcement. That's what we did in the early days at Relayr. We didn't announce the Cisco investment, and we jointly agreed on it. But then when we as a company became mature enough, we actually talked about this very proudly and also very publicly. So I think these are the main learnings from my side.
Maybe I can say a few words along the lines of what you just talked about. So I think there's two things that we have done, at least at Cisco Investments, to try to respond to some of the challenges that Josef brought up. So one is, let's talk about terms for a second. So when you make an investment, what are the kind of terms that you put in place as a corporate investor? And the second one would be sort of value creation. How, as an investor, do you bring value to your portfolio companies? And what do we do about that? So on the term side of things, I think Cisco was pretty innovative early in its days in terms of how it would go to bat with an investment. Some corporates want to come in and have right of first refusal. They want to say, if somebody else wants to come and buy your company, we get it first dibs. We get to choose before they do. we did a lot of work on this many years ago, so well before my time on board. And now, generally speaking, with, I would say, about 90% of the cases, we have no rights like this whatsoever. Maybe we just have a notification. So, hey, tell us if someone's going to buy you, that's it. And so we try to work with the entrepreneurs, because I think what there was some concerns around in the market was if we come in and place this blocker, what that's actually doing is it's making it harder for the entrepreneurs to raise money from other strategics, which we don't necessarily want them to avoid doing. And second of all, we want to make sure that the value that of the equity that we're buying is as big as it possibly can be. So if we're basically blocking off a route to market for one of our portfolio companies, it may be actually reducing the value of the equity stake that we hold. So that's the terms piece. On the value creation side of things, you know, what we've done there, and fairly recently, so this is probably in the past 12 months, we've created a team called the Portfolio Development Team. So this is very similar in philosophy, I guess, to what some of the US VCs are doing, where they call themselves full service investors. Our portfolio team, we basically got a bunch of people from all over Cisco that have been, you know, 15 to 20 years in our sales teams, and they had really wide networks within the company. We put them all in one team. And so while I sit as an observer on the board of Relayr, there's someone in the background that actually is working with a whole bunch of folks in the sales parts of the company to, you know, to look at how can we create some type of relationship with them in raising sales. So what we're essentially doing, we're not bringing in help on HR, we're not bringing in help on any of the sort of typical kinds of things that we would do with that other full service VC might do, but we are looking to try to expand top line revenue. And so what we've tried to do is create some types of programs where our portfolio companies can be part of the global price list at Cisco, or Solution Plus programs at Cisco, various programs where some of our salespeople actually have the ability to get quota for selling one of our portfolio companies' products. So I think you guys were at one point, if not still, on one of these programs. Yeah. So, and so I think those are the types of activities that we're trying to do to create a little bit more value for our portfolio companies. It doesn't always work out perfectly, but it's an effort that we try to do each and every time.
All right, thank you. So I will take now my perspective as an independent investor, and I would like to underline some statements from John as well as from Josef, which might be important for you guys. Who is an entrepreneur? Please raise your arm. Okay, good. Who's an investor? Okay, so more investors than entrepreneurs. All right, doesn't matter. So perspective on terms, very important. Josef mentioned this blocking rights. For us as an independent investor, let's assume we have invested in an A round, and in the B round there's strategic or corporate venture capital investor interested to invest in the company. This is absolutely, for us, a showstopper. This would be a showstopper if this investor, this corporate venture capital investor, would have a first right of refusal. Why? So the answer is quite easy. If there is an exit process, so if there's a potential buyer and he sees this term, right of first refusal, he would immediately stop the exit process, because he knows I can negotiate the exit, the valuation, all the terms. At the end, the guy with the first of right refusal comes along and says, okay, thank you, I will buy it. So that's why, very smart move from Cisco Investments to say, well, we don't need this, because it's really a roadblocker. It would be a roadblocker. And another point I would like to underline what John mentioned, how a corporate VC can be of help for a startup. And when I was an entrepreneur, I had a corporate VC as well. And we are working with corporate VCs, as you can see. You really have to distinguish between corporate venture capital investors and corporate venture capital investors. And that's what Josef mentioned. Do your due diligence right. Ask other entrepreneurs how this corporate investor supported them in the, after the investment. Because there are corporate investors which are investing, or who are investing in hundreds of companies per year, And you can imagine if you invest in hundreds of companies, you can't support these companies that much. If in comparison to a Cisco investment, for example, they invest, that's like a sniper, in very, let's say, in particular companies, and which have a, let's say, which are worth to support, and they have an entire team. So the difference between facilitating and really investing and supporting, it's very important for you guys if you talk to corporate investors. And yeah, these are the two topics I would like to underline. And maybe the first question from the audience. Any questions? There's one.
blockage from the point of view of a VC, because I had an experience recently that was helping a Berlin company that makes chips, has already won a corporate VC from the US on board, and they were completing a B round and looking to actually replace an investor. Long story short, quickly the question, okay, let's maybe go get another VC, and then some strategic investors, or rather corporate VCs, came into question and were actually quite interested. But some of the German VCs that were already in the Series A and B said, no. Isn't it common usually that the VCs on board would like to limit the corporates because it makes the potential value of the company smaller because of these potential roadblocks that other investors perceive? I mean, I imagine most VCs would say, okay, one corporate VC is fine, but let's not fill the cap table with a whole bunch of corporates, because that's going to just create blockages or problems or lower the value if it's a trade sale.
Yeah, very good question. It's not only the question of are a lot of corporate VCs a threat to a company. I would say the question is, are a lot of different VCs, too many VCs, a potential threat to the company, which is in most cases correct. So the question is not corporate or normal VCs. So how many VCs are healthy for a company? How big should the shareholder table become? It's always a question. So answering your question directly, it's always a question of terms. If you have the right terms, then why not? Maybe two corporate VCs. If both can really be supportive, it's perfect for the company. And it's maybe a balance of power at the shareholder table. So it really comes down to the terms and conditions. And you have, as an entrepreneur, as well as an existing shareholder and investor, you have to make sure that you don't have any roadblocks in the new contract, which might hinder you to raise another round or to have a smooth exit transaction. But maybe some other thoughts on this?
Yeah, I don't disagree with you. I guess a couple things I would say. Yeah, I agree. Too many cooks in the kitchen is always difficult, whatever kind of cook they are. But I think it's partly an issue of perception. So if you look at the Israeli VC market, that's one where Series B and C typically is done by corporate investors. And actually there, the Series seed and A investors tend to like corporate investors coming in, because that shows sort of technology prowess. It's a branding exercise, the sort of stamp of approval from certain entities. They have a clear route to potential acquisition or partnership or other things that. So it's actually viewed as a positive thing. I think that some of the negative perception that you're talking about, particularly in Europe, has been partly a historical issue due to the way that some of the terms used to be constructed, or still are in many cases, by certain corporate VCs. So I think it depends a little bit on the terms, as Olaf was saying. To give you an idea of how we approach it, again, we typically don't take a board seat. We typically take a board observer seat. So we hang out, we listen, we try to help, but we don't ever have any real power to be able to say what to do or not to do. And I think that's probably perceived very positively by most of the entrepreneurs that we work with. It's also because we're taking fairly, reasonably smaller stakes than some of the financial VCs as well. But I think that's that makes it a lot easier for it's a much easier conversation to have when you're there and all you're trying to do is help, and you don't really have those types of levers that other investors might have. I think it's a much easier conversation.
Yeah. And I think we have to compare United corporate investors and German corporate investors. Let's take Cisco or Intel or Google Ventures. So they are highly skilled teams, or we're talking about highly skilled teams with a lot of, let's say, background experience in normal venture as well as in startups. So if you take some upcoming or already gone venture arms of German corporates, sometimes they just want to play a little bit in this field. They don't take it serious. If the balance sheet is, let's say, going to the negative side, they stop because they're investing out of from the balance sheet. So that's why I think some good examples in Germany is Bosch. They are doing it for decades now, and I think they're doing it very well. And then, you know, from the media, you read it. There's a new venture arm of XYZ, and you're asking yourself, so who are they going to invest in? So yeah, look at the track record and do your due diligence.
Well, you said everything.
Okay. More questions? More questions? No?
How would you deal, like, let's say there's a corporate investor coming in and he's offering strategic add-on value to the company, services and so on. How do you manage potential conflict of interest? Because the company might have other sources, but there's a tendency potentially to be more likely to get the services from the investor than from a third party, even though the third party might be better suited, might provide the services cheaper or otherwise. Like, how do you manage, like, first question, is there a conflict of interest, or is it just like a theoretical problem? And if so, how do you deal with this? How do you make sure that the dealings are all at arm's length terms?
Well, I can give a real-world example. So one of our investors is Munich Re, insurance company. And the reason why they invested in us was because of the strategic upside they see with technology, right? So they do a lot of reinsurance for equipment breakdown, as an example. So IoT, you know, censoring up equipment helps them to be smarter because they already have a lot of data, but it's another source of data. But in order to do so, they need to develop new IP, right? So that they have to basically, there needs to be a marriage between technology knowledge and what they do on the PhD and math side inside the company, and then bring it together. So, and if you just do this on a pure partnership side, the problem that they would have is, you know, that we would have all that knowledge exclusively, and then we could go and shop it, and then there would be a lot of, you know, they wouldn't necessarily have an advantage with it from a go-to-market perspective. On the other side, for us, it's really, really important to not enter any exclusivity when you get into an engagement, so that we can actually go and shop as, you know, their, you know, strategy might change, leadership might change, right? So I think that's the way that we did it is we first of all negotiated the business terms, and then we both, you know, found out, and this is a process that took a year roughly, right? They were a customer and partner, and then we figured out there's a really interesting strategic notion here. So it makes sense if you own a small piece of the company, right? So that you feel ownership, and that, you know, proved to be, you know, a really interesting model, and it's working quite well, because although we would have the option to work with anybody else, as we're so close with them and jointly developing new IP, the likelihood to do it with them, you know, per default is very, very high. And then over the 2 years of the investment, there was a very strong relationship that was created, and, you know, you have to train their salespeople and their channel. So I think that's my answer. So look at the business side, and then let a potential investment follow with the right terms again, and don't start with an investment, then artificially look for business cases that you can jointly develop.
I would like to draw or paint a picture here, which I have seen in the market. So just imagine you're an entrepreneur of a startup, you raised seed money and A round from a normal investor, not normal, you're not unnormal, it's from a usual VC. And then you're on the market and you have partnerships with, let's say, corporate A, competitor corporate B, competitor corporate C. And now the venture arm of corporate A comes and says, well, I want to invest in you. No blocking rights, clear terms, and you take the money and it's going public. So that A invested in you. Guess what B and C will do? Will they disappear as a customer or as a partner? No, because they need the technology, they need the product, but maybe they are alerted that there's something going on and you will get an offer much earlier for the entire company. So it's a signaling if a corporate VC is investing. The same way it's signaling if a triple A and a VC is investing in you. Or?
Yeah, I would say.
Would you agree?
Yeah, yeah. Yeah. No, I think at the end of the day, it all comes down to the message you want to send to the market, right? I mean, when you start a company, you have nothing, right? It's pure insanity, right? You're competing against everyone. You have no product, no experience, no nothing. And you get knowledge and experience and traction from your investors, but you get brand, right? So for us, when Kleiner Perkins invested in us, this was huge, right? So a lot of traction with there. Then you have Cisco investing, and Cisco is known for doing heavy due diligence on the technology. So they proved the technology. Kleiner proved the sales side, right? So you're checking boxes, and your brand just grows. And with your brand, it's so much easier for you to sell stuff, right? So it's a self-fulfilling prophecy. Then you have, we have, I would say, one of the most aggressive venture capitalists out there investing us, that's Kleiner. And then we have one of the most conservative corporate investors, which is an insurance company, and even worse, a German insurance company, right? So how much more conservative can it be? So you just get more credibility on the way, right? And that's something that a lot of people underestimate. What signal are you sending?
So more questions? Please.
How long does your due diligence technology due diligence take? So what are you telling the startups, how long do you take for the due diligence? Because a lot of companies or startups, when we are talking today, they say that your corporates are too slow, it takes too long, emails are not answered. So is it 6 weeks or 3 months? How do you communicate with the startups and make sure, because they want always money fast, within 40 hours or 1 week, so how do you communicate this kind of thing?
Yeah, sure. So what I would say is we don't give people like this many weeks or this many months. What I would say is we're typically on the order of the typical round type time frame. So I think where some of the challenge has been in corporate investing is that it's less about the, let's call it the technical due diligence, and it's more about the decision-making process that happens internally. So I think the technical due diligence for us might be 1 or 2 meetings with engineering, right? Various engineers that we sort of use for due diligence in various different areas. So it's probably not much different than what a typical VC would do. Where I think the long cycles have tended to be in the market, and I don't think we have this problem because we've got a pretty fast, we've got a typical sort of Monday morning partners meeting, probably like you guys, and then we've got an investment committee, probably like you guys. So it's a very similar process, but our investment committee is 3 people, and they're always the same people, and they do this kind of day in and day out at Cisco, aside from their other jobs, but they know exactly what they're doing. What I've seen the decision-making process at other corporates being is we pick 20 people randomly from the business that don't know anything about this space, and we ask them what they think, or something like that. So I think that or you need to, in certain cases, at many VCs, you need to have buy-in from a business unit, and so there's a whole extra cycle where before you go to the investment committee, you've got to get sign-off from some VP or GM. We've done some investments where there's literally no one to talk to at Cisco. I invested in a company called AI Motive this year. It's a self-driving car OS company in Budapest. Cisco's not doing anything in self-driving cars. There's literally no business person to talk to. In fact, it was even sometimes challenging for us to look for due diligence internally. We had a couple engineers that helped us, but we also relied on some people outside of the business. So I think we're pretty good, but in some cases it's that decision-making process that's slowing things down rather than the tech due diligence. Hope that answers your question.
Yeah, I would add one more thing. If somebody invests in you, in I would say in a quarter, then you might, so I'm not talking weeks, I'm talking 3 months, then you might really reconsider if this is the right partner, because how much homework did it really do? But how much effort did you put into understanding your business model, your team, how many reference visits did he do? And how is it just, just throwing money at you? Because then the likelihood of him adding value is really low, right? So when we raised our Series B as an example, we got to know the investors for over a year, and we had a chance to get to know each other, and then really, it's never really about the firm, it's always about the partner on the private investment side, and with the strategic, it's about the real value that they're providing. And this assessment that mutual due diligence needs to take 6 months, right? Otherwise, you're working with them for quite a bit, right? So you want to make sure it's the right partner.
More questions? Yes.
Yeah, it's a great question. So, I would say that we define success pretty similar to the way that financial VC would. So we look at ourselves as if we were a fund. We track IRR over a 5-year period or over the life of the investment, depending on how we look at it. But we always want to have, I think the difference in corporate or even strategic VC is that you always want to have more than just financial returns. And it is challenging sometimes to have these conversations inside of a corporate about what's the value aside from financial return that this portfolio company is bringing to the business. I think that Josef alluded to this earlier, which is that we see it as strategic learning. That's why we're in the business of doing venture at all. So the way I try to describe this is, we report up to the chief strategy officer. And if you look at, we also have a corporate strategy team. They do PowerPoint, and they do a lot of McKinsey-style consulting work, as you would expect. And let's call that publicly available information. What we're basically doing is we're working with very leading-edge companies like Relayr in a space that we may not be in today. And we're looking, by sitting on the board with them, we're looking at what they're looking at a year in the future. And so we're really able to get this kind of view 2 to 3 years into the future of what's coming down the road for Cisco. And so you sort of take this, it's like being, the guys that go behind enemy lines with the night vision goggles, right? You take that kind of proprietary intelligence and you take that sort of desk analysis and you put that together, and that's the best strategy that you can come up with. So I think we tend to measure ourselves both by the financial return and, hey, what are we learning? How are we impacting on our own business? And how are we also helping the portfolio companies?
To this question, the value chain of, let's say, of learning and of disruption and innovation when it comes down to technology, I think that the most directly impact is you innovate by yourself as a corporate. And Cisco, I know Cisco since my studies more or less. You have acquired 204 or 205 companies now.
212, I think.
212. So okay. So Cisco will learn from the first beginning that innovation it's tough to do it in a corporate, so they are acquiring companies, as well as investing in companies, as well as investing in venture funds. So Cisco is one of our LPs, and now we jump over the Atlantic and look at Germany, because we're here in Germany now. The corporates are learning as well here. So, for example, AXA, a big insurance company, is a fund investor in our fund, in order to understand what's going on in the market, what kind of technology, might be tackle them in 10 years. So not only fintech, not only insurtech, some underlying technology, enabling technology as well. So other corporates, they try to start a venture capital arm, and most of them, they fail because it's a long-term journey. And so learning is very important for corporates, and innovation is very important for corporates. More questions? We have, I think, 10 minutes left. Yeah.
You talked a lot about doing your due diligence. What if it's a first-time fund, corporate venture capital fund going into it with no past history? So in that case, both they might not have connections to invest with other VCs, and they will not have a track record, but they might have strategic benefits. So how would you evaluate in that case? What would you recommend the entrepreneur, and on the other side, what would you recommend the CVC?
Very good question, because a lot of new corporate VCs popped up in the last 5 years, and some of them already disappeared. This is a problem, and we had these discussions with our, let's say, startups and entrepreneurs, and it's a serious discussion, because there is maybe an interesting company wanted to invest, but nobody knows how they will act in 2 years or 3 years, maybe in a financial crisis. When they have to refocus only on their core business. There is no direct answer, but it's not an easy decision. And yeah, so it's a risk, but sometimes you have to take risks. But maybe you have some other thoughts on it.
Yeah, I think you have to differentiate between a financial investor and a corporate investor, because even if there's a lot of first-time funds out there now, but as I tried to mention earlier, it's all about the partners. And partners are human beings, and human beings have a history, right? So even if these people have not been investing, they have a history, and you can still do due diligence on the people, right? So that's on the first-time funds. On the corporate venture side, I think always assume the worst, right? Because it doesn't necessarily have to be, as Olaf just mentioned, it can be you're a fintech and you have there's a big financial crisis, then Hypovereinsbank is a great example, right? And then they might just change their strategy and liquidate their assets. Then I think you always have to make sure that you protect, the company, and this has to do with the terms again, right? You got to make sure that whatever they do on the corporate side, which nobody can really decide, right? Because the people you're signing off with might not be there anymore. You got to make sure that you have, terms that ultimately allow you to protect the company. And this is, I think, independent to this being a 20-year-old venture capital fund or a corporate investor or a new one.
I'll say a few words about what you just said. It's slightly different from your question, but I think it does raise one of the challenges with corporate venture. I know I said I would say everything is roses, but I think the biggest challenge with corporate venture in some cases is that the strategy of the corporate can change. Right? So it's not just the venture arm may disappear or go away, but also the corporate may change as well. And so if we make an investment today, we're thinking about where we could be in 3 to 5 years, but when 3 to 5 years comes down the pike, our strategy may be very different from what we thought it would be. And so sometimes that's one of the challenges that you work on. The expectations that you have up front don't necessarily always come out. I think it's the same thing with the VC side of things. You have to figure out a little bit about how the decision making is done, where you think they're going to be in 3 years, how solid is it, and try to understand whether the strategy is going to change as well.
I think we have time for 1 or 2 more questions. Yes.
How do you manage the differing objectives and ambitions between investors and often CEO founder-led businesses where investors have an investment horizon? How do you sort of tackle that occasional misalignment of objectives?
Very good question. Has nothing to do with corporate venture capitalists. I think this is has something to do with being an entrepreneur and giving away some power, some shares of your own company. It's rather easy. The entrepreneur is sitting on the driver's seat, the investor is standing at the sideline, and it's not operational. But maybe, Josef, you're the live entrepreneur.
I think a great example of this is, I mean, on the corporate side, it's very easy because if you like go into a competitive situation with somebody your corporate investors might not necessarily like, there's a very easy way to solve this, right? Very easy, just buy us, right? It's a little bit more challenging when you talk to financial investors on the return side, as an example, right? Because your company might go really, really well, but you go, I as an entrepreneur, it's all about feelings, and you see something coming, and you try to see transformations, in markets, and you go like, and you're trying to constantly answer the most challenging question, which is around timing, right? When to start, when to raise money, when to exit the company. It's a very, very tough call to make, and sometimes there is a great misalignment between the corporate, the venture capitalist and the entrepreneur. But if you have the right VC, even if he disagrees with your assessment of the timing or the price, he would still be supporting you, because first of all, that's his job. He also has a fiduciary responsibility to his LPs. That's why the discussion is valid. But what most good VCs are very, very focused on is their reputation, right? So reputation is everything. You fuck up one deal and you have a real problem, right? Especially in the world that we live in now. So I think it's in their own interest, not only from a financial perspective, but also from a reputational perspective, to support the founder with whatever decision he makes.
Yeah, maybe two examples. One example is sitting here. I can remember, so Josef and his management team came to us, said, guys, we think it's time to sell the company. We got some knocks at the door from Cisco and from some others. And sure, as a VC, you said, oh, is it right timing? Can we wait 2 or 3 more years and then sell it to double the price? Or so, but the management, they are working the market, and they have the gut feeling and all the details. Sure, as a VC, as a board member, you are challenging this idea. But in this case, we followed the management, and company got sold. Everybody was happy. But there's another example, maybe everybody knows this example, that Mark Zuckerberg got, I think, the first offer for 300 million, something like this, and his wingmans and sparring partners said, don't do it, don't do it. Rest is history.
The only thing I'll add to this is VCs tend to have closed funds, so they have a certain time frame that they have to exit everything by. Corporates don't necessarily have that, so that's the one maybe small advantage that we have, is we can be a little bit more patient. We don't necessarily sit on the board anyway, but where a VC that's a corporate does sit on the board, they may not have the same kind of time frame concerns. Hey, we want to, because the other thing can happen. Sometimes you can sell too soon, but sometimes you can wait too long. And so somebody, the VCs tend to want an exit. And that's the one thing where we're slightly different.
Do we have time for one more question? One more? Okay. The timekeeper says one more question, so one question. Nobody? Really? Oh. Here we go.
Sorry, so maybe I will ask. So my question is related to, I would say, buying majority as a corporate VC. So what kind of scenario do you have when you enter investment? Do you already have the right to, I would say, buy the majority of all the, I would say, bigger stake in the company or not?
No, we do not. So when we invest just like everyone else. We tend to take a percentage of the company in terms of equity. We don't have the right to buy more than our pro rata share in the next round. If we decide that we want to buy the company, then we come in and we make an offer, and maybe they'll take it, maybe they won't. So those two things are really quite separate activities, I would say. And so, and by the way, just as a side note, when we come in, Cisco, we always, if we're going to buy the company, we buy the whole thing. So we buy 100%. We don't buy a piece of it or a majority of it. We tend to buy the whole thing or nothing. So hopefully that answers your question.
Right, then I think I should close this round. But request to the audience, if you want to talk to Josef, I think you're here. 15 minutes,
Yeah.
half an hour?
Yeah, 15 minutes.
Yeah,
or-
15
I've got
minutes,
cards
so
here. Yeah.
grab this guy. If you want to get investment from Cisco, talk to John. If you want to get investment from Capnamic Ventures, talk to me. Thank you.
Thanks, everyone.